Hello everyone and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to talk about rolling. So if you're brand new to this segment, this is a segment where we construct concepts in a visual way. So rolling is actually one of the more popular topics in support specifically. We get a lot of questions about rolling, what it means, what it gives you, what you can do with it. So today we're going to break down the rolling strategy. And one thing I want to point out is that rolling is basically when you're closing your old trade and you're opening a new one at the same time. So this can be done for either a net debit or a net credit or for even. So we at is for even or a net credit because that's when the benefits come into play. So let's throw on the first slide here and we're going to look at rolling a naked put. So we're going to be looking at a 45 put in September with the stock trading at 50. So these numbers are all arbitrary here, but you'll see the bigger picture when we get to it. So we're going to sell the 45 put for $1. So the probability of profit on this trade we have marked as 60%. So this is over 50% because we're out of the money. We're selling an out of the money put. So if we review from other whiteboard segments, an out of the money put is basically selling a put below the stock price because a put gives the owner of the put the right to sell 100 shares at a certain strike. So if I'm selling that right to someone, then that gives them the right to sell their shares at 45. And right now the stock's trading at 50, so the put has no value or no intrinsic value right now, so it's considered out of the money. Now, if I'm selling a put for 45 for $1, that means that my max loss is going to be $4,400, and that's because instead of selling the stock at 45, so if I'm selling the right for someone to sell me the stock at 45, if the stock price goes to zero, I'll have to buy back this put for $45. But since I received $1 in credit for that, that brings my break even lower than 45 to 44. So let's move this along and see what happens when the stock price moves down. So we sold the September put originally for $1. Now the stock price is trading at 40. So let's say we're right around September expiration and we have intrinsic value. So intrinsic value is essentially this difference between the stock price and the strike price. So if I sold a put at 45 and the stock price is now 40, that put has to be trading for around $5 at expiration. I've got it for over $5, $5.05, because you'll always see a little bit of extrinsic value up until expiration. So we sold the September 45 put for $1. Now we have to buy it back for $5.05. Or what we can do is roll the trade into the future. So here we're closing the September put for $5.05 and we're opening the October naked put for $5.75. So what this does is gives us a net credit and it reduces our max loss. So if we look at the analytics of this particular trade, we're going to have our max loss reduced and a net credit shown of 70 cents here. So what this does is allows us to go further out in time and let us collect a net credit. So in a sense, we're giving us more time to be right or keeping the dream alive, as you might hear on tape. And that's one thing that we're going to want to do. So you'll see that the probability of profit here is lower than 60%. So that's another thing that we want to take into account. Yes, we're keeping the dream alive and we're receiving an additional credit for this trade in particular, but our probability of profit is now much lower because we're selling an in-the-money put for October. The stock price is now at 40. So for this to be profitable, the stock price has to move. Whereas originally when we sold the 45 put when the stock was trading at 50, we could have been profitable if the stock price didn't move at all, moved up, or moved down a little bit. So that's one thing to keep in mind when rolling, is that once you roll defensively, you have to be directionally right. So again, 35% pop, these are arbitrary numbers, but you get the picture that now it's a lower probability trade. Our max loss has gone from 4,400 to 4,330, and that's because we're collecting an additional credit. So again, we're buying back the September put for 505 and selling out the October put for 575. So let's discuss why we can do this. So if I'm buying back the 505 put or the September put for 505, and I can sell the October put for 575. The reason I can do this is because there's extrinsic value assigned with more days to expiration. Just like when we were talking about on an earlier whiteboard about extrinsic value, when we push the option out in time, that option is going to have more extrinsic value, which increases the option price. So since we can do this for a net credit of 70 cents, this is a good trade. My directional assumption is the same. So I still am bullish on the underlying, but I want to give myself more time to be right. So I decide to roll the trade instead of close it. So we've got a net credit of 70 cents. Our max loss is lower, but our pop is lower as well. So let's tie this all together and see what it all looks like on the next slide here. Also, we've got a realized loss of 405. So this is really important to take into account. So although we're giving ourselves more time to be right with this 70-cent credit, we have locked in a loss of 405. So originally, if we go back, thinking back to the original side, we've got the put that we sold for $1. So if I sell a put for $1, for me to close that position, I have to buy it back. So if I'm flat and then I sell an option, I have to buy it back to close it. Or if I'm flat and I buy an option, I have to sell it back to close it. So since I sold it for $1 and now I have to buy it back for 505, that's a realized loss of 405. It's just the difference between the two. Sold it for $1, buying it back for 505. The difference between that is 405. So let's throw it all together on the next slide here. Our old break-even price was $44, and you can see that with the green arrow here, it's less than 45 because we received that $1 credit. Our new break-even with the roll is going to be $43.30, and it's lower than our original break-even because we're collecting an additional credit. Now, we have a new trade that's going to have a lot of intrinsic value because we're selling it for $5.75. So it's got $5 worth of intrinsic value right now and 75 cents worth of extrinsic value. But since we're adding more time, we can collect this for a net credit. So our old break-even is now worse than our new break-even, so that's great for us, but our probability is lower. So that's just the big idea with rolling, is that although if you have the same assumption, you have to realize that you're opening a new trade that's got a lower probability of profit. So how can we reach our break-even price? So we collected $1 originally, and we collected an additional 70 cents net. So now what we have is a collection of $1.70. For me to break even, I would need to close this position for $1.70 because basically if I collect $1.70 and then I buy back the position for $1.70, that means that I've broken even. So it's all basically a simple math equation. So if I take the realized loss of 405 and subtract $1.70, you'll see that that's the difference here. So what you need to keep in mind is that whatever credit you received, for you to break even on that trade, you need to buy back that position for that same amount. So that would bring you to a flat position. So let's get to our takeaways with rolling here. So number one, rolling is the result of closing your old position and opening a new one at the same time. So again, you're not giving yourself free time or free expiration days for nothing. You're closing a position, especially rolling defensively. You're closing that position for a loss and you're opening a new position with a lower probability of profit. But if you can do it for a credit, you're going to reduce your break-even price, which is what we're all about with cost basis reduction. Again, we keep the dream alive when rolling. So if I close a position in September and I open a new one in October, I now have a whole nother month for me to be directionally right and correct on the trade. And I can even reduce my break-even point, which is going to help me out all in all in the trade. So rolling can reduce cost basis further. So again, like you saw here, we opened the trade for $1 and then we rolled the trade for an additional 70 cents, which since we're collecting more premium is going to reduce my max loss and reduce my break-even point. When rolling defensively, the pop of the new trade will be lower. So this is a crucial concept to keep in mind, is because no matter, even if we roll into perpetuity, regardless of how deep in the money it goes, we might be able to continue to get credits for naked option positions. You'll see it's going to be much harder for debit spreads or credit spreads or anything else. Any type of spread, it's going to be much harder to get that credit or roll for even than compared to naked options. But when you roll that trade with a naked option, you just need to keep in mind that the further in the money it goes, it's going to be a lower and lower probability of profit. So for me personally, I need to consider when I'm making that trade whether I still want to keep that on or if I can take the trade off and use that capital more efficiently elsewhere. And last but not least, rolling defensively results in locked-in losses, but keeping the trade open gives you a chance to offset that. So in this example, we showed a realized loss of 405, but we opened the new trade for 575. So if that trade goes all the way out of the money, so if the stock price goes from 40 to above 45, I've now completely wiped out that realized loss that I had, and I also get to keep that $1.70 in credit that I received for all those rolls that I did. So this has been rolling. If you've got any other questions about rolling, shoot it over to support@tastylive or support@. You can tweet us at or at tastytrade. Tomorrow we're going to get into a little bit of strategy. So we're going to talk about covered calls. We're going to break it down completely, and we're going to discuss why we do this and what benefits we can receive from placing a covered call as opposed to just buying stock outright. So thanks for tuning in. My name is Mike, and this has been Mike and his whiteboard.
Hi everybody! I hope you liked this video.
Click below to watch more videos, subscribe to our channel, and don't forget to watch us live at tastytrade.com.